Futures trading involves substantial risk of loss and may not be suitable for all investors.
From panic to profit, from crisis to celebration. Good morning, it's Thursday, April 10th. Thanks for joining me. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So yesterday, President Trump announces a 90-day pause on reciprocal tariffs for most countries while raising tariffs to 125% on China. The S&P 500 sees its largest daily gain. It's up 9.5% since October 2008. So the FOMC, they had their March minutes and they reiterated that the Fed is well positioned to wait for more clarity on inflation and economic activity, emphasizing a high degree of uncertainty in the outlook. So that makes sense right there. So I heard it all yesterday, and are we out of the woods yet? And let's dive into the anatomy of a bear market for a second. And this is one of the books that I keep in the library here, written in 2006, and I read it during COVID here. So it doesn't touch base on any of those developments here, but it really does break down some of the bear markets that we've seen. So you look at the anatomy of a bear market, and there are essentially three different types of bear markets. You got structural, that's like a financial bubble. You got cyclical, and that's determined by mostly monetary policy in the cycle we're in. Usually it's fueled by a very restrictive Federal Reserve. Then you've got event-driven, that's like your COVID, your tariffs, your 9/11. So cyclical, that's your most common, with the average decline 30% from the peak. Now, why is the sell-off that we've been seeing so aggressive? Well, it's that we were already structurally unsound with valuations so high. I had a lot of people just shorting the equity market, saying that these valuations can't go on like this. And I could agree to some extent with what they were looking at here. But then you start to look at the effects of the higher for longer coupled with sticky inflation. That points to the economic downturn. That's where your cyclical comes into play. And then you get the event-driven tariff policy kind of acting as dynamite rather than that slow-burning fuse. So how do we bounce from here? It's usually a combination of cheap valuations, extreme negative positioning, which we were starting to see that. Bank of America puts out this fear and greed index, and we were kind of banging that lower aspect here on the fear aspect. And then you get the policy intervention, which we're not really getting that, and that's why I read the FOMC minutes here last night and kind of wanted to get a gauge as far as, what was Chairman Powell thinking and what's kind of the attitude and the temperature of the Federal Reserve officials here. And then you get that slowing macroeconomic deterioration. So you need the Fed to kind of change its stance. You need the deterioration at the same time shortly after kind of to slow down here, and then that extreme negative positioning needs to rocket fire back to the long side. So the average bear market lasts about 25 days. So, and that's just coming back out of bear market territory. That's not saying that we're going to go and make a new high with a V-shaped recovery here. So today we are going to have some market moving events here beyond this discussion here. And if you look beyond President Trump, and I listen to like several different squawk boxes that are just basically rattling off information all day long in the background, and many different officials, central bank officials, not in the US, and also leaders of different countries are constantly in discussion and coming up with their own ideas here how to combat different inflation. So I think that's why we're seeing a bit of a sell-off here of the equities overnight. It's one, where people over-positioned. They want to pare some of that down here. Two, some people are still getting defensive. And then three, just because of the fact that President Trump does something doesn't mean that other leaders are going to act in kind. So we will have CPI coming out here later today, and it's most likely step down in March thanks to the drop in energy prices. So consumer price index is seen rising 0.1% from February, and at the same time, the core measure that excludes food and energy here is expected to firm up to 0.3%. We're going to have the unemployment claims. We're going to have numerous Fed speakers come out, and then obviously the masters are taking place here, so we're going to want to watch that as well. So checking in on the precious metals. Gold pushing on up again here, extending a bit of gains here, and up about 1.8%, up $58, $31.37. So when you look at the charts and everything on it, you're going to want to see that it is butting up against that upper trend line again, where it kind of poked through and then it struggled, and a lot of people took tactical shorts there. So you look at the gold silver ratio, silver just under $31, up 53 cents. That's a 1.74% move. And then you got copper up 4% here. So it's $4.36, up 17. Aluminum's up 60. Platinum's up 14. Palladium's up 18 here. Palladium back over $900. But the gold silver ratio, and this is kind of what I'm watching here, and gold and silver aren't, they aren't the same. Silver is 54% industrial demand. It is involved with a lot of different products there. The global economy slows down. Obviously, copper demand slows down. Silver demand slows down too. People seek safety in the gold market. The gold-silver ratio does get stretched. In times of dramatic uncertainty, like what we're experiencing right now, people really go into the safety, and they really take down their global growth products that they're owning here. That's why crude oil prices are coming off so much here. So, the industrial commodities, they've been under pressure for several weeks. We track that gold-silver ratio because it does act as some type of barometrics as far as, is silver a bit too undervalued in comparison to gold? And a lot of people took their gold positions off yesterday with that massive move upwards, and then held on to their silver, looking for a bit of a snapback in the gold-silver ratio. So despite the recent gain, it's the major uncertainties that remain on how the tariffs are eventually going to play out and how this episode will affect commodity demand, trade flows, monetary policy. So how do they rally? How do you get silver and copper really rallying up here? Well, one, they could be dragged higher from the gold market. That doesn't necessarily mean that it's going to have this explosive bang to the upside, because the chart patterns, if you look at the gold market, I send this out in the chart pack, you could see that for like 2 years now, gold has been in this upward channel. Silver's kind of just been all over the place. Yes, it is going higher, but it's more in this consolidation phase between, call it 29, 25. Yes, you have Sunday's washout, but I'd say realistically that floor is 29, 25. Where's the upper boundary? $35. We haven't closed above there, and we did, but we're going to need more fuel in order to get this higher. So realistically, we're in this range bound thing, and in the chart pack, and if you don't get that, just register in the link below in the description and we'll send it out to you here. I update it usually around 10:30 in the morning, 10:15 in the morning, and then it's got to be something has to move really to drive me to send it out. Otherwise, I'll wait about 48, 36 hours and then I'll send it out. And we did add the S&P 500 because when you look at the S&P 500, that was rallying up. And then we had this flag going on, and it was about that 6150. We started to break down a bit. And now you're going to want to look at, there's a long-term trend line where we come in for support, and that's where we bounced off on that Monday session in the last couple times. So that's really your key level of support. Now, a lot of these commodities, when they get stretched too far down, we'll look at fib retracements for different areas to either lighten up, take tactical shorts, or reposition in the market. So you're going to see a lot more Fibonacci retracements go on there, and then you also see the trend lines, but you're not going to see the bells and whistles of stochastics and ADX and DMI plus and minus. We want to keep this very simple for people to understand here. So, how do they rally again as far as silver and copper and break away? Well, you need China's top leaders. They are set to meet to discuss additional economic stimulus in response to President Trump's increased tariffs. The meeting is going to focus on support measures on housing, consumer spending, technological advances, things like that. And that's where it really affects the silver, the copper, the rare earth elements, things like that go into those aspects of it. The housing market, if they could stabilize that, that brings up copper. And that's what really starts to get the copper squeeze back underway. But we are still pretty far away from $4.50, $5, etc. to the upside. $4 has been your critical level support on the front month on that copper market. Now looking at what else we're going to talk about here is that the economists and a lot of people, and China is a very proud nation, they don't want to see this, is that they are lowering GDP forecasts for them. That tariff response had really slashed GDP, and they try and get to 5% down to 4 and 3.5%. So they want to get that GDP back up there. So they are expected to step up their policy support for financial markets and also exporters here. So again, on gold, key levels of support here. You get back down, you look at that 29.85, that held. That's something we put on the chart pack as well. And then again on silver, it's 29.25. So you got to look at where these markets close at, not necessarily where the extensions of the wicks are. And you also get the ETF flows here. Well, the exchange traded funds, they added 353 ounces of gold in the previous session here, bringing this year's net purchases to 5.33 million ounces. And then you get silver, big move up here. They added 426,000 ounces of silver to their holdings in the last trading session. So this was a third straight day of growth in that silver ETF here, in the total silver ETF. So year to date, and kind of a summary of precious metals holdings, gold plus 6.4%. So a big jump there. We were 6% yesterday. And then silver 0.5%. So you check on some other markets here. A lot of markets taking a bit of a breather. Equities coming off just a bit here. Again, I think it's people lightening up. Again, it's people, the euphoria, the panic to profit, the crisis to celebration kind of is wearing off. I'm not going to lie. Did have myself a little bourbon there yesterday, so with response to that at the golf course. But, you look at where things are at. Let's see if things are starting to wear off a bit, because crude oil prices here down about 2.5%, back below on the May contract, below $61. Prospects of a major rebound in crude oil, like 75, 80, 90, $100 crude, really unlikely here unless we have some material conflict underway with Iran. But it's the uncertainty, the weakening demand, the rising production from OPEC, and many energy analysts are expecting it to resume its downtrend once the optimism around the recent tariff reprieve kind of fades here and the demand side headwinds start to persist. And that's what we want to watch in other key commodities as well. So if you guys got any questions, reach out. Sure to register in the description below for the chart pack. We got a lot of great content that we put out, especially Oliver on the grains, the livestock. We've got Dan doing the energy report. We got Bill doing the morning express with the stock indices. I'll write the metals edge. And we've got several special reports we put out there. We're going to start to add Bitcoin, crude oil, things like that on the chart pack and kind of build out from here. But you guys got any questions, reach out. Shoot an email to info@BlueLineFutures with anything that you need. And then also remember, futures and option trading, it does involve risk of loss. May not be suitable to all investors. Good luck, good trading. Go get them. Watch the Masters. That might be some comfort and enjoyment away from the chaos in the markets that are going on.